Hello and welcome to today's video on the volatility tax. I'm Kaleb Paddock, founder of 10 Talents Financial Planning. We're talking about investments today and specifically the volatility tax. So what the heck is this? What does volatility mean? It just means the ups and the downs. Investments go up in price, they drop in price. There are natural fluctuations in any market cycle. This is normal. This is totally normal. One of my jobs for my clients is to set expectations around this. Let you know, hey, if you invest in a certain way, this is what you can expect when pandemics strike, right? When financial crises happen, what can we likely expect in terms of upside or downside? It's mostly downside. Everyone doesn't really worry or get bothered about the upside. They care about the downside. So today I want to talk about this concept about the volatility tax. Now, the volatility tax breaks apart a common misconception, which is if I want more returns, if I want my money to grow more, all I need to do is just crank up the risk so high, because as we all know, more risk, more reward. And what I want to show you today is that that doesn't work in all times, in all places, and we can show that empirically with just the mathematics behind ups and downs in the market. So not always does it make sense to just pour gasoline onto your risk and just take excessive, reckless risk in terms of your investment strategy or the things you invest in. That doesn't always work, that you can just crank up risk and always 100% of the time get better returns. So I'm gonna share my screen. I love using this whiteboard feature. I'm gonna turn off my video and then we're gonna show you this screen here. All right, so the volatility tax is our topic for today. And what we're going to do is give you an example, an illustration. So let's start off with a $10,000 portfolio, okay? We'll keep the numbers relatively small, nice round zeros so that the math is easy. So let's talk about when this investment drops in value. So we'll switch our colors here, do a nice red. Let's have a drop in value. We're gonna drop this by 50%. All right, so a pretty risky investment that could lose half of its value. We're now sitting at $5,000. Now, to the layman, the logical solution here, and what I've been told from real people is no problem. As long as we get a equal increase back upward, right? 50% down, 50% up. We're gonna break even on this puppy, and we'll be just fine. But let's just walk through that. Let's just walk through that math. So let's say your $5,000 here goes up in value by 50% from that $5,000 mark. You're gonna notice something interesting. Have you broken even compared to your starting price? And the answer is most assuredly no. You were down 50%, up 50%, those should just even out, right? I know basic math, negative 50, positive 50, that was like what? Third, fourth, fifth grade, somewhere in there. Number lines, right? Do you remember number lines? Going back and tracing negative 50, positive 50. That would be linear, right? We're not going linear here. Math or investments, we're going into geometric returns, compound interest, right? This is a different discipline than just a linear, simple addition and subtraction. So you're in fact at this point, if you're up 50, or sorry, if you're down 50 and then up 50, you're actually down 25%. This kind of gives you a window into what I'm talking about with the volatility tax. If your investments are very volatile, wild strokes down, wild strokes up, you really need a lot of wildness on the upside to make up for this. How much do you need, right? If you've been looking at this, probably thinking, what would I need to just break even, get back to this original number here at the very top? And the answer that you would need to get back up is plus 100, right? So you'd need 100% gain to offset this 50% loss. And that can happen, right? That absolutely does happen. We think back to the great financial crisis. Yes, the S&P 500, the largest 500 companies in the United States, had a horrible, greater than 50% loss. And about 5 to 6 years later, it did recover eventually. So, not to downplay that, but for many investors, especially if you're retired, if you are waiting 5 to 6 years to just break even, that can be more than most people can stomach. If for no other reason than it's very discouraging, right? So it's very discouraging to see that downturn and then have to wait so long to see the recovery. You do oftentimes eventually recover, but not always. There are certain sectors of the market, oil, commodities, there are things that can be down for 10, 20 years before they break even. This would highlight a separate topic of being beautifully diversified so that we're not exposed to just one sector or one style of investment that could be negative and never break even for 10 or 20 years. And that happens. So something to be aware of. Let's do some different examples though on the high end and the low end for this so that we can see some other examples. So let's start back up at the $10,000. Let's say instead you had a more beautifully diversified portfolio and instead of being down 50%, we've got some exposure here and we're going to be down 20%. So let's say you're down 20%. You know, that doesn't feel good either, right? That doesn't feel good either. This would drop in value to $8,000, right? So we don't want to minimize that. That would not feel good either. However, what do you need to break even in this portfolio? Well, interestingly enough, you only need 25% gain to break even. So you might say, well, on the downside, I was hedged, or I was kind of protected on the downside. But on the upside, we only need 25% to break even in this example. There we go. Little technical difficulty. So you can start to see, you know, down 50%, we need 100% to break even. Down 20, we only need 25% to break even. And again, the math here is this: to go from 8,000 back up to 10,000. Right, that was our break-even mark. We just need that $2,000 gain divided by 8, right? And there is your 0.25, right? 25% gain to get back to that break-even mark. So very quickly we can realize, wow, this is mathematically more advantageous to limit some of this downside. Now, to be clear, to be very clear, we don't want to limit this. I mean, if we limit this to like 1 or 2%, now you're just sitting in cash and probably like really conservative bonds, short duration bonds. So we're not trying to get this down to 1, 2%. But if we can limit large losses, you know what? Let's just define that as 50%. If you can limit these 50, 60, 70% drawdowns, by being beautifully diversified, you can have more success, better outcomes over time. I want to show you one more example just to emphasize that. We're going to start at the $10,000 once again. Okay? I want to just hammer this home as we close out the video. Let's say you believe more risk, baby, more reward. Let's fire up the risk because I'm a risky player and I want to go crazy. So let's say you're down 80%. All right, so you're going to drop in value to $2,000. And you say, you know what? Doesn't faze me for a minute. Not phased for a minute. Everything comes back. This investment, whatever it may be, it's going to hard charge all the way back to my original investment. I'm breaking even. I'm breaking even on this sucker. All right, you may. There's no telling whether we may or not, but what's the math behind this? Well, you're probably looking at this going, oh my goodness, the math is going to be wild. So here's the deal. You've got to get $8,000 in gains, okay, just to break even. If you're doing this quick math in your head, you've got to get, what's the math here? Drum roll. The drum roll is 400%, right? 400%, right? Not 100, not 150, not 200. You got to get 8,000, right? Show the math here. 8,000 divided by 2,000. Okay? You've got to get, let's do the division there, 4.00. You've got to get a very large gain, and you have to white knuckle this all the way back. And by the way, let's say you get your 400% gain. All you did, my friend, was you broke even. Let's light off some fireworks for breaking even. Yay! No gain, no loss. We just held still. Hopefully, this is a great illustration and makes sense for what we call the volatility tax. Just because we expose ourselves recklessly to wild up and downside, that does not mean that we're going to be a more successful investor, that we're going to see better returns than a beautifully diversified portfolio. So thank you for tuning in to the video today. I'm really glad that you watched this. I hope this was helpful. Again, this has been the volatility tax video. If you enjoyed this video, please smash that like button, subscribe to the channel if you haven't already, and you can be notified of videos like this one, educational content on things like the volatility tax. Thanks for tuning in today. Bye-bye now.